Welcome to the Hospitality Maverick podcast with me, Michael Tinkser. We at Hospitality Mavericks are here to inspire leaders to create heart-centered and profitable businesses from the inside out, the kind that both employees and customers love and support. In this episode, we're talking to Ali Aneizi, the founder of Tamweel Capital, an advisory business with one foot rooted in the institutional world and the other firmly planted in the camp of the consumer-facing brand-led entrepreneur. They have over the last 3.5 years helped challenges brands such as Swingers, Gymbox, Inception Group, and many others with fundraising deals. Ali has more than 20 years of experience in private equity and M+A, working with founders in hospitality and leisure. Ali talks about how his entrepreneurial journey originally started with hunting opportunities in Libya and at the same time overcoming a personal health crisis back in 2013. And that in the end took him back to hospitality and leisure. He gives an ultra clear overview on how the investment landscape looks in the moment, the type of investors that are out there, and reveals he thought about how landlords could pivot into becoming investors in progressive brands in the near future. We also talk about what the most progressive brands and operators are doing to survive and thrive by either building formats that are experience-led or have focus on multi-channel revenue streams. There's some great out-of-the-box thinking in this episode, so make sure you're fully tuned in and have your notebook and pen ready and enjoy. Welcome to the Hospitality Maverick podcast. We are in early August. We are in this funny space of the pandemic where I just said before to the guest we are going to present in a moment that we are in this wilderness of really walking slowly forward. And hospitality is open. We have a lot of things going on and sales is going up every week. But not many people are actually thinking about further than maybe a month or a couple of weeks ahead. And today's guest is a bit different guest than we have had in recent times. We've had a lot of operators and consultants and experts. Today we're going to talk with Ali Aneizi from Tamweel Capital, which actually, sees a lot of businesses and help them raise money and advise them in that. Ali, welcome to the podcast.
Thank you, Michael. Thank you for inviting me.
I'm really been looking forward today because it's probably not something I haven't definitely not noticed it, but a lot of people is probably not in the moment talking about raising money. How do we scale the business? It's all about survival, as we mentioned before we went on the air. But it could be interesting just for people that doesn't know who you are and what your teams are doing, because you're doing some quite interesting and incredible things. You're definitely working with, as you say yourself, with the challenges of our beloved retail and leisure and hospitality industry.
Yeah, okay. Well, let me give you sort of a potted history of my journey. For many years, I had a very vanilla, very corporate, and some would say quite a predictable journey, quite a predictable career, which looked no different to many others across the city. I trained and qualified as a chartered accountant with a firm called Baker Tilly, who are now RSM. I qualified with them in the late 90s. And then I spent the next 15 years working in their mergers, acquisitions, and private equity team, mainly advising founders and owner managers on small cap, mid cap deals, largely sell side and fundraising roles for growth businesses. And like many professionals in my position, I climbed the corporate ladder. I became a partner in 2008, and I was responsible for the firm's leisure, hospitality, and private equity efforts in the UK. And it was all good. I learned a lot. I, in particular, learned the craft of deal doing, built up a solid network within those sectors. Things were going well, but it was all a bit vanilla. And after 18 years of sort of being immersed in the corporate world, I started to fall out of love with it a little bit. And given I'd spent my time advising entrepreneurs how to mitigate and manage risk in their deals, it didn't feel right that I had never taken any risk myself. So I started to wonder what life might look like as an entrepreneur. And strangely, this thinking coincided with the Arab Spring kicking off and the revolution in Libya. I'm Libyan by background, and when all of that was happening, I got very excited about the prospect of a Gaddafi-free Libya. When that revolution was successful and Gaddafi was toppled in middle of 2011, all sorts of opportunities started to emerge and come my way. And the topic of state building became something of interest. And so I convinced myself that the opportunities in Libya were many, that this was my calling to have a front row seat and play a role in the rebuilding of Libya, and to take some risk, go on a proper adventure, help bring democracy and corporate best practice and prosperity to the Middle East, he says naively. So I resigned from RSM in early 2013, who, by the way, they thought I was nuts and was having some sort of midlife crisis. But they were very good, very understanding, really supportive, kept the door open for me to return if things didn't work out. And that for me was the sort of the comfort blanket and the safety net that I needed to take the risk. And so I formally left the partnership in the middle of 2013 to start this entrepreneurial journey, to start this Libya adventure. And I immediately had my first setback. 1 month into this journey, I was thrown a proper curveball and was diagnosed with stage 2 blood cancer. So, not the best way to kick things off.
Well, just imagine, with talking about how tough it is right now, that must been like, looking at a lot of things at yourself and in the mirror and trying to, not only from a health point of view, but also picking yourself up mentally and go and do the thing in far away from London. Even what happened then, and how did you actually cope with all that?
Well, it's a long story, but touching on it briefly, it wasn't fun. I ended up spending best part of 9 months in and out of hospital, going through chemo, whilst at the same time working on getting this Libya business off the ground. Look, I tell many people that it was definitely, one of the most challenging periods in my life, but it was also the best thing to have ever happened to me. It put many things into perspective, and it reminds you. I mean, it certainly reminded me of the finite time we have on this world, and of our mortality. So it was a real sort of eye opener. I'm one of the lucky ones. I was able to beat the disease. In my sixth year of remission. I've never felt better. I was very fortunate, and that's the good news. The bad news is that the Libya journey, despite my best efforts, the Libya project was proving incredibly challenging. And yeah, in many ways, I struggled more with getting the Libya business off the ground than I did fighting the cancer.
Wow. Okay. But again, like it's amazing that 6 years now out on the other side. So congratulations on that. While I remember saying that, yeah. But then, what happens after Libya then? Because then you put that to the side and said, okay, I need to find you. I guess like anyone else, you needed to have a roof over the head.
I mean, the Libya sort of adventure was tough, largely because there were just too many bad guys and not enough good guys on on the Libya scene. With more people interested in draining the state of its resources than building it. And so, the dream that I had, that many of us had, of a sort of a free and prosperous Libya was looking increasingly unlikely. And I always knew that there was risk of this. And so when I set out on this journey, one of the things that I was very keen to do was to make sure that my network of relationships in the UK didn't decay, and that I made an effort to stay in touch with that network and keep that network warm, whether it was in the leisure and hospitality scene or in the private equity community. And so I was 3 years into the Libya journey. It was early 2016, and a former client of mine, Richard Hilton, founder of Gymbox, a London-based gym chain, who I had advised for many years whilst I was at RSM, reached out and wanted help with his next transaction. So, Richard and I had been talking on and off for many years. He knew I was off doing strange things in Libya, but he wanted to know if I could advise him on his next deal. So that actually was the start of the pivot from focusing efforts on Libya and getting back to the world of M&A and the vanilla world of M&A and private equity. So I took on that Gymbox mandate, and Richard and I, the rest of the team, we spent a big chunk of 2016 working on that deal. And pleased to say we closed that deal in October of that year. Got a great result despite a wobble with the Brexit referendum. We were able to get it over the line. Got a good set of terms for all those that were involved, and it was that deal that reminded me how much I enjoyed transacting, how much I enjoyed working with challenger brands, with founders, and with private equity. And so it was around this point that I decided to wind down my Libya business and sort of get back into the world of M&A and private equity deal doing. But I wanted to do it differently. I felt there was a gap in the market for an M&A and private equity boutique focused exclusively on advising challenger brands. So, these are the brands that are shaking it up, doing things differently in their respective categories. And I wanted to provide an M&A service that delivered the best possible results for its clients, without the baggage that comes with dealing with a stuffy institution. So, we wanted to be like a smaller, more agile version of a Rothschilds, but without the sort of the corporate label. And so we ditched the suits, we put on the sneakers, we parked up in fun offices in Portobello and hired talented people that had a similar attitude and a similar outlook. And here we are. It's 3.5 years later. We've advised and completed some of the sector's most standout transactions, some of the best challenger brands in the world of leisure, and we've established a name for ourselves as being a destination and a go-to advisor for the best and the brightest challenger brands in leisure, hospitality, and wellness.
And for people out there, can you mention some of those brands, because they are quite well known, some of them?
So the journey kicked off with the Gymbox. That was a deal that we closed, like I said, back in 2016. It was backed by BGF. That was a 50-something million pound EV deal. Shortly after that, we closed the deal with Frame. So also in the health and fitness category, but this was a business that provided pay-as-you-go classes. That was a deal backed by Piper. And then the next deal is a deal that really sort of got us on the map and got us noticed, was with a business called Swingers. So, these are the mini golf, crazy golf, food court, beverage brand that are doing great things in the world of competitive socializing. Those deals, I mean, like, you couldn't pick a better set of brands and a better set of businesses to start your journey with.
Yeah, and I think it's Swingers is they're particularly interesting because they actually designed a new way of delivering hospitality, leisure, going out and have fun in a different way. And we had Matt on the podcast, one of the co-founders. I think it was back in January, talking about that journey in a way. And I guess I could imagine that journey has been very different now when they haven't had been able to have guests in their venues for some time now. But can you tell me a bit about, what happened then? Like, everybody thinks, what happens then when you have the pandemic, you're helping people raising money? What happened for you? What happened for the clients in this period of time? And we don't know how long we're in it yet. If it's 12 months, 18 months, or 2 years, nobody knows. But what's happening at your side of the fence?
I mean, it's been uh, a real a real kick in the nuts for the sector, hasn't it? It's
Yeah,
been
that's a very nice way of saying it.
it's been quite a sobering time, actually, for us, for our clients, and the sector more widely. On a personal level, it's been incredibly frustrating. We were looking forward to having a bumper 2020. We had 3 deals on the go before COVID struck, one of which was a week from completing, which we'd been working on for 9 months. And we had a pipeline of some amazing formats, amazing businesses, many of which, we were the favored advisory solution for. So things were looking promising for us as a business. And then the sector had had a good Christmas, and the like-for-likes in January and February were looking encouraging. And some of the businesses in our pipeline were absolutely smashing it. And so the backdrop for 2020 for us and for the sector, was looking really promising. And we were gearing up for a busy year of deal doing. And then there was this chatter about a bug going around and, some sort of a virus. And, before you knew it, overnight, every single client we had and every single business in our pipeline shut down and went from being highly profitable, throwing off cash, to being highly loss making and burning cash. I mean, it was nuts. And in a very short period of time, the the record 2020 that we were looking forward to, I mean, it just went up in flames. And the reversal of fortunes was quite something to both witness it with our clients, and feel it firsthand in our business.
Where have it left you? Have anyone come back and say that, well, we still want to pursue this. We will just need to find, ourselves in all this, and find a way out of the, probably most of them are still in survival mode. I guess there's no one that has come out yet and said they are ready to go and make deals right now. But I guess there's a reality of a future where you will come back, where people will need that kind of financing actually to move on and actually, recoup the business as well. And I guess there is investors interested in investing into the sector in general as well.
Yeah, I mean, look, the it was a strange time. um, I spent almost the entire 6 8 weeks of lockdown on the phone with clients and operators, not deal doing, more providing therapy and counseling to founders who were shell shocked by what was going on. And these are people that had shed blood, sweat, and tears building their businesses, often over many years, often on the back of significant financial sacrifice. And suddenly their livelihoods were on the line. And so I spent that time, well, trying as best as possible to keep a cool head. But occasionally I felt like curling up into a little ball, rocking back and forth in the corner of the room. Our transactions went, the 3 deals that we were working on basically went on ice. Well, 2 of them went on ice. One morphed into an accelerated fundraising. And our clients and the sector more widely turned their attention to, like you say, survival. So there was brutal cost cutting, the flurry of furloughing, intense discussions with banks, landlords, suppliers. It really was adrenaline fueled and a wacky time. And I suspect business schools the world over are going to be lecturing about this period for decades to come. So I think people have acclimatized. We've been through the shock of it all. The lockdown is loosening, people have opened up, people are trading, and I think week on week, people are getting a bit more visibility on what that trade looks like, and week on week, that trade is improving. And I suspect that, it's going to take a while before regular deal doing, the sort of investment activity that we saw pre-COVID returns. It's going to take a while for us to get back to sort of pre-crisis levels. But that's not to say that there isn't activity taking place as we speak. It's just a different type of activity.
With all this carnage that's gone on and still going on, when you talk investment, you could imagine that activities has stopped, and how would it look for the future, and when would it actually go back to anything looking, I wouldn't call it normal, but the new normal for investment? When will that kick in again? Because I guess there is still activity going on, but I guess it's not the kind of normal investment. Is picking up deals that can be turned into something, the turnaround kind of stuff. But what is your view on the whole investment landscape and the coming time for it?
There are three buckets of investors out there, but only two of them are currently looking to do deals. So you've got the turnaround guys. So these are investors that are set up to buy businesses in difficulty and out of administration. The current crisis is a perfect backdrop for them. They're busy. And then there are the sector specialists that have real conviction in the industry, conviction in its medium to longer term future. They're much better placed to form a view of risk, and they see the current climate as a good buying opportunity and a great time to deploy capital. So they're also busy. Then the third bucket of investor, the generalists, I think they're sitting on the sidelines, adopting more of a wait and see approach, and I suspect it will be a while before they have the appetite to get back into the industry. So in short, the universe of investors has certainly shrunk. But we expect that investor appetite will rise once things start to normalize, and in particular once operators can point to a P&L and an earning stream that they can forecast with some confidence. The amount of money out there remains at an all-time high, and the pressure to deploy it is significant. Albeit institutions need to remain disciplined. The other interesting thing that I think we may see over the course of the next chapter is the commercial real estate landlords potentially building out their own in-house leisure and hospitality investment teams. So if you think about it, the real estate asset class is not very different to private equity. They are both long-term investors. They are both illiquid asset classes. They both seek to generate above average returns. And these in both both these investor pools have access to capital. The only thing that's stopping commercial landlords from getting in on the investment game is talent and lack of familiarity with private equity investing. And let's face it, they have had it so good in over the last few decades, they haven't needed to be innovative. But I think we may well see landlords bringing private equity investment skills in-house. And this is not a new trend. It was underway pre-crisis, and I think it will accelerate. And we've seen it in deals that we've worked on ourselves. So Swingers, for example, that was backed by Kane International. Kane are a real estate investor who happen to have developed an in-house leisure investment arm. The owner of Equinox, the premium gym chain, is owned by Related Properties, massive real estate owner out in the States. Soho House recently received, or late last year, received $100 million of investment from a consortium that included Simon Properties, the biggest small owner in the state. So I think there may well be an increasing trend over the course of the next chapter of us seeing the commercial real estate guys getting more involved in the ownership of leisure, hospitality, and retail assets.
A super interesting thought, because actually you think about it, you go back in history and thinking about, how McDonald's built their empire, how hotels, Hilton and so on, have built their empire. They're property owners. They invest in operation that brings the value up of their properties. Super interesting, Ali, view, and I've never thought about that in all this, but yeah, I can see that needs something like innovation from the landlords has to happen, as they have these assets anyway standing there.
I think it will be triggered and driven by needs to begin with. So landlords need tenants, and tenants obviously need cooperative landlords to make it through this difficult period. In the absence of this sort of innovation, landlords are going to be left with a whole bunch of empty units. And I think that this crisis may well trigger a different approach and a different way of doing things. And, if it's successful and they generate good results and good returns out of it, then who knows, it may become increasingly mainstream for landlords to offer up funding solutions, equity-driven funding solutions in the sector.
You also mentioned the operators before. They are, right now trying to find their way forward, looking at their P&Ls, their weekly sales, and they're trying to forecast themselves into a way. And it's going to take some time before they, with confidence, you say, really can show some projection that will, keep or make confidence within some investors. But what are they doing? These operators are doing the right thing. There is some operators doing, incredible things. They're innovating on a level. They're building new revenue streams, reinventing business models, and so on. What are you seeing within the industry and the clients you're working with? Because I guess that's in a way where investors get confidence as well, that the organization can turn it around and find new ways.
Look, I think there are two ways for hospitality operators to go. Either you go big on experience, or you go big on multi-channel. And if you're fortunate enough to be able to do both, that's the holy grail. I think businesses that are experience light or are dine-in only are going to be exposed. And the buzzword at the moment is resilience. And operators, the good operators out there, are spending time thinking about how to build resilience into their formats. And one of the things that the pandemic has shown us in a very visible way for some is, the fragile nature of the sector, and in particular how dependency on dine-in only formats comes with risk, and how easy it is for guests to consume product from home. So either you have a format that cannot be replicated from home, which takes you down the experience route, or you embrace the consuming from home trend and build out your multi-channel offering. Multi-channel is a topic that is being looked at very hard by operators. Formats with eat-in, delivery, takeaway, cooking at home, retail. These sort of multi-channel formats are able to spread their revenue generation across several verticals, clearly giving them more flexibility. They don't have all of their eggs in one basket, albeit it's going to add a layer of complexity to their ops.
And I guess that's the big, question as we come back in. Can the operation model and the team lift the task of all the things they're inventing? Is there any particular things you've seen within all this where you think this is really good. This is really clever. If we say an example of the experience route and then an example of the multi-channel route.
So I think on the multi-channel side, operators that are doing that well include the likes of JKS, Patty and Bun, Pizza Pilgrims. I mean, those last two in particular, I think, have been very clever with the recipe kits that they've launched, because they've been able to combine product with experience at home, believe it or not. So, the pizza in the pie by the guys at Pilgrims, and the recipe kit burgers from the guys at Patty and Bun, that allowed the consumer, yes, to consume great product at home, but it added with the theater and the fun and the experience of making it yourself. So I think those guys are doing a good job. And there are others, Tortilla, Rosas. Many of these businesses are actually not doing too bad, given the backdrop, and given the climate. But it's clearly driven by delivery and takeout. And then on the experience side, you either need to supplement that offering with an activity, which the competitive socializing formats do so well, like guys at Flight Club, Swingers, Bounce, SEV, or your format is such that it transports guests to another world, delivering a sense of escapism, getting away from it all, providing an experience that can't be had at home sitting on the sofa. And the guys that do that well are, I think, Inception. Inception do this incredibly well with their themed formats, the Mr. Fogs and the Cahoots, and they've gone one step further by leaning into the crisis. I don't know if you've seen the use of mannequins and the beekeeper. So they've used mannequins to help with distancing. In one of their fog sites, the staff are dressed in beekeeper outfits as a form of PPE. It's clever. It's illustrative of some of the innovation that is taking place in the sector. I guess the other challenge is for operators to be seen to conform to COVID requirements whilst not creating a sterile clinical environment. So no one wants to be reminded of COVID when they walk into a bar or walk into a restaurant. They want to escape. They want an experience. That's why they are there. They don't want to feel like they're walking into a hospital, or they're giving their order to somebody that resembles Hannibal Lecter. It's a fine, but it's a fine balance, because there's still some nervousness out there. And we've done a few recce's in recent weeks post the loosening of lockdown, and it's amazing that there are a number of formats out there that have got this balance right, in my opinion. So guys at Hawksmoor, guys at Corbin and King, they've been able to deliver a COVID secure experience, but it feels incredibly normal. And I think, other than the temperature checks as you walk in and the staff maintaining distance, you would struggle to tell the difference.
I guess that's also, as you said, I think it's very interesting. Like people, the people that venture out, they're looking for a bit of an escape about all this COVID talk. And yeah, I went to the opposite experience actually myself, into a restaurant. We often go with the family, and there was like plastic screens everywhere. It was so weird that we quickly ate our meal and left again, and thinking we don't need to go there before we had hit some kind of new normal, because that was just too much. There was too much plastic. There was masks everywhere, and they need the mask, and I understand that, but it was like almost going into, you say, a hospital looking environment, and there was this.
That's not hospitality, that's healthcare.
Exactly, exactly, exactly. So it's very interesting. You and also one of the things that I think that's been very interesting when you're talking about this innovation as well is that the speed it's been done in compared to normal times, and if we can keep some of that speed and within teams and flexibility, there is big hope for the industry going forward, even though there's casualties as we look short term. So I'm quite optimistic when you can see this level of innovation within some organizations.
Likewise. And if you have a look at the interesting brands that are out there at the moment, you'll see that many of them were born out of the last crisis, 2008 and 2009. These sorts of shocks, they they often act as a catalyst for innovation and a catalyst for entrepreneurship. And so I don't doubt for a second that there are people out there, entrepreneurs, looking at what's going on, thinking there's a better way of doing things, or I've got a format that's perfect for the next chapter. And I think you will see a wave of innovation and entrepreneurship and new entrants into the market over the coming years.
So you mentioned one challenge is to keep it normal, keep it like a normal hospitality experience. Is there other challenges you would think that's relevant to be aware of there out there as an operator? Yeah.
God, there are many. It's a long, long list.
Your top two, because you already had one, so you can't have three.
Uh, um, I think the uncertainty, the biggest challenge right now is the uncertainty around customer behavior and not knowing or not being able to predict what their purchasing patterns are going to be over the next 12 months. So the operators at the moment are facing three customer headwinds when it comes to customer behavior. Don't worry, this still falls within the limit of two. I think the, the 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 three customer headwinds are fear of the virus, and as a result, stopping guests from going out. Then two, it's behavioral change that has taken place as a result of the length of the lockdown. So working from home, eating out less, eating in more. And then the one that I fear the most actually is the impact on discretionary spend due to recession and unemployment. I think unemployment is going to skyrocket over the coming months, and there will clearly be a knock-on effect. Each of these headwinds on its own is bad enough, but to have all three kicking in at the same time is I think what makes this particular period challenging. So that's one, customer behavior, and then two, the real estate element of the equation still needs to play out. It's still up in the air, and the September quarter is looming. The lease forfeiture moratorium is meant to expire. Well, then what happens then? So I think that is an unknown and a challenge for the industry, which I think remains to be seen how that's going to unfold.
And going from challenges, we also must need to go on the different spectrum or the other side of the spectrum, the opportunities, because you already alert to there's some great opportunities in here for the challenger brands, the progressive operators. What are the opportunities you see right now in all this chaos?
I think the obvious opportunity is a rebalancing and a resetting of the relationship between landlord and tenant. So, for many years, we all know it's been a one sided relationship. This is now going to change. It has to. And like I mentioned earlier, I think you'll see more of a sharing of risk and reward between landlords and tenants. Driven by need to begin with rather than want. Landlords are going to have to do this. I'm not sure they're going to have a choice in the matter unless they want to be left with a whole bunch of empty units. Uh, and we're already seeing it with announcements from Legal and General, Cadogan Estates moving to turnover rents for their leisure and hospitality tenants. So I think there is an increasing acceptance that this is likely to be a feature going forward. Then there's the other opportunity, which is to use the current backdrop to restructure. So there's a saying, I can't remember who said it, but never miss an opportunity to capitalize on a crisis. Well, a big chunk of the industry is going to have to go through some form of restructuring over the course of the next 12, 18 months, that restructuring is either going to be consensual and negotiated between all of the various stakeholders, or it will end up being forced through via some form of insolvency. And in the absence of a consensual restructuring, that's when you're going to see the CVAs and the pre-packs kick in, and we're already beginning to see a wave of that build in the sector. But I think what's different this time round is because so many businesses in the industry are going to have to explore this as an option, and so many businesses in the industry are going to have to go down this route, the stigma that was historically attached to these sorts of processes, that stigma won't be there anymore. And I was speaking to a private equity owner that's got a number of hospitality businesses in their portfolio, and historically PE, the private equity world wouldn't dream of considering these sorts of processes, but they were arguing that they would be negligent not to consider them because for many businesses it might be the only solution. So hopefully there's a resetting of the cost base to come, a rebalancing of the relationship between landlord and tenant. Hopefully coming out the other side, the sector will be in a better place.
It's perfectly to what I was thinking the next part of our conversation should be is about again, because when you grab these opportunities, there will be winners and there will be losers in this chaos. But what kind of future landscape can we see for food and drink businesses? What type of brands, operators, what do they look like compared to today?
So I think that the future, the short-term future, I think is going to be tough and challenging, and we're going to see some failures, and it's going to be a brutal case of natural selection. I think coming out of the other side, though, there is a compelling argument to make that actually this may be the perfect time for those innovative challenger standout brands to scale up, because you're going to have less supply in the market. Landlords are going to be more cooperative. There's going to be more availability of sites. It'll be easier to get hold of talent. And so, there is an argument, you can construct a compelling argument as to why this is a perfect time to be scaling up and growing your business. But it needs to be mindful of the fact that the world may well be operating quite differently, as in terms of the next chapter, whether we like it or not. Working from home, more flexible work-life patterns will become more prevalent. Even if COVID is gone, I think the working from home feature and flexible working generally is here to stay. And I think this is going to drive increased activity in the more neighborhood and suburban leisure formats. And so those that are more reliant on city center footfall, need to be mindful of this and need to consider how to address this challenge going forward. But look, in the meantime, we're going to go through a shakedown. That shakedown is going to be unpleasant, and it's going to be a sad time for many. But I think there will be brands, there will be operators that will survive, that will thrive, that will flourish. And I think they're likely to be those that are experience led, multi-channel in nature. And I think given what's going on, there is going to be an increasing interest in health and wellness, and therefore a shift towards healthier options. Maybe with some government support, with their drive on tackling obesity. So I think that may well feature as part of the next chapter. But the thing that I have absolute conviction is that the hospitality sector, the eating out, drinking out sector, is here to stay. It's just going to go through an evolution and another cycle. And there will be winners and losers in that innovation and in that cycle, uh, as there always is. And what we're going through now is just another cycle. We went through, we it might be a bit more severe and it might be more compressed, but once we're through it and we're out the other side and things start to normalize, which they will, we will look back on these days in the same way we look back on the recession of 2008. It will be history, and there will clearly have been learnings. And next time round, God forbid, there's another one of these on its way. We'll know what's coming. We'll be better prepared. Things will be different. I'm bullish and optimistic and excited about the future. I just think the immediate future is going to be challenging and painful, and sad to watch, actually.
Yeah, and I guess the survivor of this, and you already touched a bit on earlier, but also when you talk about being more aware about regional opportunities, is again the ones that ticks in with where the consumer is moving in the way they live their life in both, at work, but also at home, and what they want to achieve in their life and what kind of value they're looking for. I guess that's also one of the things that you really have to, as a savvy operator, you need to understand the new. I also call them savvy consumers because they ask different questions than they did before.
I mean, those operators that really genuinely understand their consumers, their guests, what their wants are, that is half the battle. Because if you can get in the headspace of your customer, you can then provide them with, you can feed those needs literally. Um, the problem at the moment is that I'm not sure the consumers themselves know what they want, and I think they've been as much shell shocked by all of this as operators and suppliers to the sector have been. It's just going to take a while for it to play out and for things to settle down and for the purchasing patterns to become more regular and more defined.
Yeah, I think you're spot on. Also, because we have a situation where, as you mentioned before, there will be people losing their jobs over the coming months as furlough starts to be turned off slowly, and that will make companies do redundancy. I think there has been quite a lot in the press already. In this short week, we had a lot of announcements, especially from the retail sector around jobs and being cut. So yeah, so I think you're absolutely right. You haven't seen the end of what the future consumer behavior is.
But
You're
I
spot
think
on.
what may happen on the result, as a sort of byproduct of that is, uh, yes, the recession and unemployment is likely to change customer behavior or change discretionary spend patterns. I think what it might lead to is, if people are going to go out less frequently or spend money less frequently, I think what they will end up doing is that they will seek quality when they do go out and accept that they have to pay a bit more for that quality. But on the other side of the coin, they'll increasingly look to value for the sort of the day to day, the more regular purchases. So I think that you may see a polarization take place in the industry, between those offering the best experience, the best formats. Yes, there might be a premium price attached to it, and those that are offering a sort of more value based product or solution.
And taking all this into account, in the end of the interview, we always try to come with some clear, practical advice to do out there, because as you said, there is some really dire challenges ahead, and especially right now, and there's also great opportunity for the optimistics and the survivors and the people as resilient and come through on the other side. But what would be your, like, your top three advice on where we are right now to leaders out there in the industry that's trying to find their ways back into a new paradigm, creating a new paradigm for their businesses and teams?
So I would encourage operators to take a good hard look at their format and see whether and to what extent it can be adapted to build resilience into it. So whether that's on the multi-channel side, the experience side, or whether it's with the use of technology that can help improve efficiencies and margins. So, things to do with food wastage, labor scheduling. So I think have a good hard look at format and ops to build resilience. The the other area that needs attention is, the sector is going to have a debt burden. That debt burden is going to be at an all-time high, whether it's been triggered because of C-bills or build-up of liabilities from HMRC or landlords. That debt burden now is high, and so managing cash flow day by day and week by week is going to be absolutely critical, and having enough liquidity in the business to, God forbid, handle a localized lockdown, or just making sure that you're not surprised. There are no surprises coming out of your numbers. So staying on top of your numbers, making sure that you've got good reporting, have invested in a good finance function or a good FD, I think is key whilst we go through this difficult period. And then continue talking to people in the sector and out of the sector. Share experiences, the good and the bad. And one of the things that we've seen in spades during the last few months is uh, collaboration and the cooperation that has been taking place in the sector, and the sharing of ideas and best practice. And I think that is one of the things that is going to get us through this mess. There's a collective sense that we're in it together and that operators want to see other operators do well. I've got one more. There is obviously difficulties out there, and it would be wrong to ignore the difficulties and it would be wrong to ignore the challenges. But we all need to also stay optimistic, and leaders, owner managers, founders in their respective businesses need to stay optimistic, not just for their own sanity, but for the benefit of their teams who'll need to come on this journey with them. So herd optimism, that's my final piece of advice.
Yeah, and I think that's very relevant because when there's more bad news than there's good, it's sometimes difficult, but you have to have faith in the journey sometimes. And I think that's a very key thing. And I think the other ones are very good practical advice. I would agree with all of them as well, especially the cash is king in the moment. Understand where your penny. You should always do that, but if you think you have a good system, really scrutinize and make sure it picks up all the pennies in all the corners.
I mean, there's a cheesy saying, but it's very apt, and it goes: revenue is vanity, profit is sanity, but cash is king. And whilst it's super cheesy, it's on the money.
Yeah, and that's what takes you and your team and your mission and your bigger vision about what you want to do with your organization through any kind of storm. It's the energy that drives the engine, I often say as well. So, but Ali, that was absolutely fascinating. First of all, your own personal journey, the overview you gave around the whole sector and your views on things, because you look at the industry different than we sometimes do as operators and experts in the engine room. We get consumed about putting out the fire. So that I think that's been will be extremely helpful for people out there. So thank you so much, Ali, spending your precious time on giving your view and insights. And I'm sending you all the power and energy to your team as well, coming through this. And I'm sure you will do some great things in the new paradigm. Thank you so much, Ali, for this amazing overview of the industry from an investment point of view. Really find the idea that landlords will potentially become involved with investment in brands super interesting and very likely. If investment and progressive brands is something that you would like to explore further, please check out episode 46, The Importance of Net Profit, with sector investor Charlie McVeigh. Episode 44, Setting a New Standard for Hospitality Experiences, Matt Greg Smith, one of the co-founders of Swingers. If you enjoyed today's podcast, please give us a like, share, rate, or subscribe to one of our channels. Tune in next time for another interview, and in the meantime, find out more about us and subscribe to our newsletter at hospitalitymavericks.com. Thanks for listening, and be Maverick.